So, really, it's about time we had this conversation about the tax benefits of LLC versus sole proprietorship versus C Corp versus S Corp. And this is a free course for beginners. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic because I'm doing superb. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today's conversation will be about the fiscal benefits of limited liability company versus sole proprietorship versus C Corp versus S Corp. I'm going to do a compare and contrast, and this course will be very detailed. We are going to do an in-depth exploration of the issues. But listen, if you were telling me you don't have time, you just want to spend 30 seconds on this video, here you have it. On the screen right now, I'm showing you a table that is a taxation comparison table between all types of business entities. This is a 30-second bit that you might want to take away if you don't have time for this show. So just pay attention to this. The table shows you the sole proprietorship, it shows you the taxation and the forms you have to file. So this is a 30-second bit. All right, now if you're telling me that you have time, you have 15 minutes, you have 20 minutes to spare, and you want to get the nitty-gritty, the real nitty-gritty, the real understanding of the fiscal benefits of each business structure, then stick around till the end of today's conversation because you are going to love it. Let's get right into it. Number one, sole proprietorship, the structure and taxation. What about the structure here? A sole proprietorship is really an unregistered business that is operated by a single person. So one person operates the business, right? A sole proprietor does not need to register with his or her state, pay formation fees, or follow any formal business practices. And for legal purposes, a sole proprietorship is indistinguishable from its owner. In other words, those two entities form the same person. So the person and the company are the same. Sole proprietors don't have liability protection and will be personally liable for any debts and lawsuits. What about taxes? Sole proprietorship taxes. So when it comes to paying federal income taxes, sole proprietorship are considered pass-through entities. In other words, profits will pass through to the owner of the business who then reports this earnings as personal income. So tax rates vary depending on the owner's personal tax bracket, right? In addition to federal income tax, this is very important. Owners of sole proprietorship must pay self-employment to tax. They must pay self-employment tax, the SE tax, to cover both the employer and employee share of Social Security and Medicare tax. And right now, the current self-employment tax rate is 15.3%. So that is 12.4% for Social Security and 2.9% for Medicare. What about the LLC? So LLC structure and taxation. So a limited liability company is a registered business entity that is considered separate from its owners or members for legal purposes. And unlike a sole proprietorship, LLCs provide limited liability protection, which is designed to keep the owner's personal asset safe from creditors and lawsuits. What about LLC taxes? So, although an LLC and its owner are separate legal entities, they are viewed as the same for tax purposes by the Internal Revenue Service. So, a single member LLC is considered disregarded entity by the IRS and treated like a sole proprietorship at tax time. That is to say, income will pass through to the owner's tax return, similar to the way it happens for a sole proprietorship. Now, let's do the compare and contrast here, sole proprietorship versus LLC. The main difference between a sole proprietorship and an LLC is that an LLC will protect your personal assets if your business is sued or suffers a loss. Very important, folks, very important. Most business owners choose to form an LLC versus a sole proprietorship because an LLC legally separates the owner's personal assets from the business. And this is called the personal liability protection in legalese. And what does that mean really? So when a business has a personal liability protection, they cannot be sued. They cannot be, of course, they can be sued, but they cannot be personally held responsible if the business suffers a loss. This means personal assets, things like your car, house, bank account, are protected. Very important. There are four main factors to compare between a sole proprietorship and LLC when it comes to taxes and other things. So you have liability protection. I just spoke about that. You have branding, very important. You have the pass-through taxation aspect of things, and you have the cost to register and maintain. So liability protection, I already talked about that. This means that your personal assets are protected. So and this is the number one. This is the number one element here. It really outweighs all other factors when you compare a sole proprietorship and an LLC. Yes, I understand this has no tax implication, but it can have a tax implication because the company's debts are separate from the individual's debts. Let's talk now about branding. So an LLC owner can use the business's legal name as its brand name. A sole proprietor must use his or her last name as the business name or register a DBA, doing business as, name when available. What about the pass-through taxation process? Now, both sole proprietors and LLCs are taxed as pass-through entities by the U.S. Internal Revenue Service. I already explained that, right? So the IRS looks at the LLC as a pass-through. This means that the business profits will pass through to its members to be reported to their personal tax returns. All profits are only taxed once at each member's individual income tax rate. Only once. We spoke when I will talk to you very soon about the S Corp and C Corp when you have the concept of double taxation. But for LLC and sole proprietors, you only have single taxation. And you also have the cost to maintain and register. So an LLC is a low cost and low maintenance business structure. A sole proprietorship with a DBA is comparably priced. What about single member and multi-member LLC taxes? So the thing here is that while many LLCs pay taxes in the same way as a sole proprietorship, an important difference is the flexibility afforded to LLCs, especially when it comes to selecting their tax status. Because the IRS does not recognize an LLC as a taxable entity with its own tax structure, it allows LLCs to choose how they would like to be taxed. And an LLC can choose to be taxed as a disregarded entity versus a partnership, or elect C corporation versus S corporation status. I'm going to break it down for you. Now, just so before I get into that part of things, the reason why the IRS sort of looks at an LLC as a disregarded entity is because an LLC is quintessentially a state structure, right? So you register your LLC. You don't register your LLC at the federal level, but you register it in the state in which the company is going to operate. So it is essentially a state, I would say, legal formation. All right. So now, single member LLC. So if you own a single member LLC and would like to retain the pass-through taxation of a sole proprietorship, you can choose to keep tax that tax structure for your business. It's easy. So with this structure, your LLC will not pay any federal income tax at the corporate level, and profits will simply be reported as business income on your personal tax return along with your personal tax obligation. Partnership. So a partnership's tax structure is essentially, if you think about it, it's essentially the same as a sole proprietorship's, except that the business profits are split among the partners. And this is the default tax structure for multi-member LLC. Owners in a partnership must also pay employment taxes. Remember, they're not employees, right? So they are partners. What about S corporation? So an S corporation is a pass-through tax classification and is not subject to corporate taxation. So unlike sole proprietorship and partnerships, though, the S Corp owners can save money on employment taxes by distributing their earnings to members and passive shareholders. So owners of an S corporation that play an active role, those must become employees and be paid a reasonable salary. Reasonable is it's an important element here when it comes to judging from the IRS perspective. So those employees must be paid a reasonable salary, earned income based on their position and industry. And this earned income is subject to both personal income tax, and employment tax, while the remaining business profits are only subject to personal income tax. So the thing here is that after all, distributions are allocated and properly taxed. This remaining business profits are then known as retained earnings. So you have C corporation. So the C corporation tax status differs considerably from other business structures. So C corps are the only business structure subject to corporate taxation. All right. So this is something you have to really. And since 2017, the corporation are taxed at a flat rate of 21%. And in addition to this amount, shareholders must pay taxes on dividends, resulting in double taxation of at least a portion of your business income. So this is why I was talking earlier about double taxation. All right. So when electing C Corp status, business owners are not subject to self-employment tax. And you have the sales tax. This is actually, there is no federal sales tax, but both LLCs and sole proprietors need to be aware of any relevant sales taxes in their home state or municipality. All right. And this will vary depending on your location, your type of business, and the specifics of your business transactions. And then you have an annual report filing fee for LLCs depending on the state. So it's very important to know the tax requirement of your state. As I said, an LLC is a state legal formation, so you really want to pay attention to that. While federal tax law will apply to businesses across the country, it is critical that you familiarize yourself with the particular tax obligations in your state. Very important. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We're also having a convo about the tax benefits of LLC versus sole proprietorship versus C Corp versus S Corp. Let's talk about S Corp versus C Corp. What's the difference? So C Corp and S Corp are two different ways that an LLC or corporation can be taxed. I want you to remember that. I want you to take a note, to write this down. C Corp and S Corp are two different ways that an LLC or corporation can be taxed. So you have S Corp versus C Corp taxes. So C Corp and S Corp are two different types of tax statutes. So S Corps and C Corps are often misunderstood to be business structures. They're not. Let me give you an example. Limited liability companies and corporations are business structures that can both elect to be taxed as C Corp or S Corps. All right. Now, what about S Corp taxes? So the S Corporation tax status, also called Subchapter S, is an IRS tax designation that allows business owners to elect to be taxed as employees of the company. And this could lead to tax savings under the right circumstances. If you do it right, you can actually benefit from that. So what are the S Corp tax advantages? So S Corps can avoid double taxation when compared to C Corp tax status. When owners, for example, let's say when owners of an LLC elect S Corp status, they become employees of the LLC for tax purposes, and this can lead to significant tax savings under the right circumstances. What about the S Corp tax disadvantages? So for corporations, S Corp status can rule out the benefits of being a corporation, such as attracting investors, right? It also limits businesses to one class of stock and presents several other restrictions. We'll have an entire show focused on that. So for LLCs, using the S Corp status only helps if you can meet S Corp restrictions and save money by being taxed as an employee owner. And I'll just talk about this later on. So given all this sort of conditions, when to choose S Corp tax status? You can actually elect S Corp status when you form a legal business structure. It can be a corporation, it could be an LLC, or after you form an LLC or corporation. You can do it before or after. However, a business should never start out as a corporation taxed as an S Corp. In a corporation, The S Corp tax status rules out the benefits of a corporation and leaves you with a business structure that is complex to maintain. Corporations should only use the S Corp status if the corporation is already in existence and they have been instructed by an accountant, it could be a CPA, an EA, or a tax lawyer, to correct their tax status. So if a business owner is ready to form a legal business structure and he or she wants to be taxed as an S Corp, it's very important that he or she thinks about forming an LLC with S Corp status. All right, so this is what you just need to think about. And I just want to say that LLCs should use the S Corp status when the business meets S Corp restrictions, very important. The business earns enough in net profit to pay a reasonable salary and at least $10,000 in distributions annually. And the addition of payroll and accounting costs does not outweigh tax advantages. So you have to think about the pros and cons here. So this was for S Corp. Let's talk about C Corporation taxes. So the thing here is that we've heard a lot of people confuse the terms. So the term C Corp is often used to mean the same thing as corporation. All right, it's just corporation. This is because corporations are taxed as a C corporation by default. The IRS calls this type of corporation a subchapter C corporation or simply C Corp. And LLCs can also be taxed as a C Corp. As I said earlier, an LLC, whether it is multi-member or single member, can elect to be taxed as a C Corp or as an S Corp. So businesses taxed as C Corps pay a federal corporate tax rate of 21% on net profit. It's a flat rate that has been in existence since 2017. So C Corporation then distribute their profit to shareholders in the form of dividends, and shareholders then pay personal income tax on this dividends again. This is referred to, as I said earlier, double taxation, right? So double taxation essentially means that the profit of a company are taxed at the corporate level and again at the shareholder level, which means that the shareholders are double taxed, right? So the tax rate on the ordinary dividends paid to shareholders is the same as the individual federal income tax rate, which means it will vary depending on the person's income. What are the C corporation tax advantages and drawbacks? So C corporation tax pros, the advantages. A small business tax as a C corporation can attract investors, hands down. And this is because shareholders only pay taxes on dividends they receive, not the entire profit of the business. In any other tax structure, the shareholder would owe taxes on profit regardless if they received payment. C corporation only pay 15% taxes on profit carried from tax year to tax year. And the thing here is that in rare circumstances, small businesses might carry over enough profits from one tax year to the next to warrant being double taxed. And a corporation is taxed at about 15% for all profit that carry over to the next year. And a business owner, under those circumstances, if he or she is taxed as an S Corp, will pay FICA taxes and income taxes on the carryover, which will be higher than the 15% corporate rate. So those are the kind of the kind of calculus, the kind of fiscal calculus you need to think about. So what about the C corporation tax disadvantages? So the thing here is that under a C corporation, business owners face double taxation. That's one of the biggies. That's one of the drawbacks here. And double taxation is only favorable if outweighed by C corporation benefits, like being investor friendly or carrying high amounts of profits from year to year. So the big question here, the $1 million question here is, when do you choose C corporation tax status? So if you have a small business, you should choose C corporation status when you need to attract investors or you want to carry large amount of profits from one year to the next. Let's now just dig into that, choosing a business structure. So corporation, most small businesses start at LLCs, but there are some instances where when starting as a corporation makes sense. For example, if you want to attract venture capitalists and investors, You need to carry profits. I already said that, from one year to the one tax year to the next. And there is benefit in managing a complex business structure. What about S Corp? So the only time a business owner would benefit from having a corporation taxed as an S Corp is if they mistakenly formed the corporation in the beginning and need to correct their tax status, right? So this is kind of important. The S corporation, so you understand, was introduced to relieve the burden of double taxation. That's really what it is. But S corp tax status rules out the advantages of operating a corporation, like being investor friendly, and leaves you with a complex business structure that is challenging to maintain. And an LLC is most likely a great structure for your business if you don't need to attract investors. You have your own cash, right? You plan to invest most of your profit back into the business each year. Remember, investors need to receive dividends, so if you don't need them, then you're fine. You have a full latitude to reinvest the cash that you earn into the business. And you might also want to go with an LLC if you would benefit most from if you want to benefit most from an easy to maintain business structure. And an LLC who elects S Corp. Now, it could make sense for an LLC to file taxes as an S Corp if there is enough net profit to pay owners a reasonable salary and at least $10,000 in annual distributions. And the S Corp tax classification allows business owners to be taxed as employees of an LLC. And under an S corporation scheme, the business owner does not have to pay self-employment tax on his or her salary, and distributions are only subject to income tax. So the S Corp tax benefit here is that instead of paying self-employment tax and income tax on all distributions from the business, an S Corp owner pays only FICA and income taxes on their salary and only income taxes on distributions. And this could lead to major tax savings under the right circumstances. I'll be right back right after this. Don't go anywhere. Welcome back, folks. We are still continuing our in-depth exploration of the tax benefits of LLCs versus sole proprietorships versus a C Corp versus S Corp. Let's now talk about let's talk about starting an S Corp. Only LLCs should elect to be taxed as an S Corp. Very important. Now, businesses should use the S Corp status when the business meets S Corp restrictions. The business earns enough in net profit to pay a reasonable salary. The addition of payroll and accounting costs does not outweigh tax advantages. I'm showing you right now on the screen a little table where I just want you to take a screenshot and remember this. S corporation, reasonable salary, profit is distributed, tax savings outweigh the cost, meets the IRS requirements. Please take a snapshot of this table on the screen right now. So reasonable salary, again, under IRS guidelines, owner employees need to be paid a reasonable salary. And this is any salary that you would pay someone to do the same job. This is as simple as that. So LLCs taxed as S Corps are subject to increased scrutiny by the IRS. So if the owner is not paid a reasonable salary, this could lead to the IRS denying S Corp status and may lead to fines and back taxes. Profit and distribution. The S Corp election allows a business owner to disburse an LLC's profits to owner employees in the form of salaries and distributions. Then the IRS then applies the FICA and income taxes to only the salary, and distributions are subject to only income taxes. Okay, and if the LLC does not earn enough profit to cover a reasonable salary and distribution, it really will not make financial sense to elect the S corporation tax classification. And assuming if the LLC owners would like to forfeit salary for any reason, he or she could be subject to fines by the IRS. So you got to be very, 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 very careful here. You also need to think about the positive return on investment. So at the end of the day, I want to say right now, it does cost money, folks, to elect and maintain an S Corp. It's a very complex business structure. So filing fees with the IRS are minimal, but the additional bookkeeping and payroll costs are not. For LLCs that already have employees and payroll costs, this factor won't hold as much weight. So business owners should weigh the cost of, maintaining these services against the fiscal tax advantage of electing the S Corp classification, right? So the thing here is that generally speaking, a reasonable salary plus $10,000 in annual distributions is enough to make the S Corp financially viable. What about the IRS S Corporation requirements? So the IRS requires that businesses that elect the S Corp status have 100 shareholders or less, and they are only allowed to issue one class of stock. The owners of the business must be U.S. citizens or permanent resident aliens, and owners must also be private individuals and not business entities such as LLCs, corporations, or trust. So speaking about that, how do you actually start an S Corp? If you are thinking about claiming the tax benefits of an S Corp, how do you start that? How do you actually structure things? You can start an S Corp by forming an LLC and then choosing S Corporation status when you request your employer identification number, your EIN, from the Internal Revenue Service. Just as a reminder, EIN is your company's social security number. It's just as simple as that. Now, there are 5 main steps to starting an LLC. First, you have to name your LLC. You have to choose a registered agent. The registered agent is basically the person or the company who's going to take care of things at the state level. As I said earlier, an LLC is a state formation, is a state legal formation. So you want to choose a registered agent. You want to file the articles of organization. You want to create an operating agreement. And you want to get an EIN and file Form 2553 to elect S Corporation tax status. All right, so you will elect S Corp on the EIN form that we're showing you right now on the screen, the SS4. One thing I also want to say is that you can actually also file online. We are showing you right now, there is a link that we are leaving on the screen right now where you can actually go to the IRS website and file from there. One thing that's very also important to remember here is that at any time, please avail yourself of expertise, the right kind of expertise. Trying to get a lawyer, that's very important, especially if this is your first time having a business. You want to have a lawyer around you. You want to have someone who understands the intricacies of LLC versus sole proprietorship versus S Corp versus C Corp, especially from a tax perspective. So it's better to have a lawyer or a tax lawyer. You can have a corporate lawyer or a tax lawyer. One thing I also want to say is that you also need to think about the bookkeeping and accounting aspect of things. Because again, we're talking here about the tax benefits of the kind of business structure you choose ultimately. So you need to have experts around you to help you, especially if you have no clue about finance yourself. And it's okay if you don't have the expertise, it's fine. You just need to surround yourself with the right crew. Very important. So it is important to also choose the smart incorporation type. So you have many choices when it comes to incorporating a business. So now let's talk, and the incorporation has, of course, some tax considerations, and let's talk about that. So sole proprietorship tax considerations. So the business and the owner are legally the same. I said that before. There is the concept of a single entity. So from the IRS's perspective, the business is not a taxable entity. Instead, all the business assets and liabilities and income are treated as belonging directly to the business owner. This is for a sole proprietorship. What about general partnership tax considerations? As with sole proprietorships, the business and the owners, 2 or more, are legally the same. So a partnership is not a taxable entity under federal law. There is no separate partnership income tax, as there is no corporate income tax. Rather, income from the partnership is taxed to the individual partners, very important, through the Schedule K1. We'll talk about K1 later on, not in this show, but in another show. All right? So Income from the partnership is taxed to the individual partners at their own individual tax rates. So, for tax purposes, all of the income of the partnership must be reported as distributed or passed through to the partners, who will then be taxed on it through their individual returns. What about limited liability company LLC tax considerations? So, a separate legal entity created by, an LLC is a state legal formation, right? So, it is a separate legal entity created by a state filing. So, under state laws, LLC owners are given the liability protection that was previously afforded only to owners of a corporation, shareholders. Nowadays, LLCs are treated like partnerships for federal tax purposes unless they elect to be treated like a corporation, which most don't. And so an LLC has a pass-through taxation, which means, as I said earlier, that no tax on the LLC's income is paid at the business level. Income loss is instead reported on the personal or tax returns of the owners, and any tax due is paid at the individual level. Keep in mind, though, folks, that even though LLCs are treated as partnerships for federal tax purposes, the same is not always true for state tax purposes. Very important that the distinction here is critical. So I also want to talk about the C corporation tax considerations. So a C corporation is a separate legal entity created by a state filing. So the C corporation, also called a regular corporation, is actually subject to corporate income tax. So income earned by a C corporation is normally taxed at the corporate level using the corporate income tax rates. C corporation income is also subject to what is called double taxation. Very important, right? And I already talked about that, because this is when the income of the business is distributed to the owners in the form of dividends, because dividends are taxable. Tax is paid by the corporation on its income, and then again by the owners on the dividends received. And if the owner draws a salary from the corporation, that salary is also subject to income tax and FICA. What about S corporation tax consideration? So an S corporation is a separate legal entity created by the state filing. So the S corporation really is a corporation that has filed a special election. I spoke about that earlier. And so the corporation has filed a special election with the IRS to be treated like a partnership or LLC for tax purposes. Consequently, S corporations are not subject to corporate income tax. Rather, their income is subject to what is often called pass-through taxation, where the income of the loss is passed through to the owners, right? So the bottom line here is that having pass-through taxation means that S corporation income is not subject to double taxation like C corporation income. So one thing I want to say just to close today's conversation is I want to show you right now again, if you have stuck with us till the end of today's conversation, I'm showing you again the table that I showed at the beginning of today's show, the taxation comparison table. So in this convo, I spoke to you about the tax benefits of LLC versus sole proprietorship versus C corporation versus S corporation. And I'm showing this table to you as a summary. So the taxation comparison table. So you have the business entity type. It's the business separate from owners, the taxation strategy, and the tax forms filed with the IRS. Let's start with the sole proprietorship. So the business is not separate from owners. The taxation, so income or loss is reported by the owner, and the tax form filed are Schedule C or Schedule C Easy to Form 1040, an individual income tax return. For the general partnership, the business is not separate. You also have the income or loss is reported by owners, and you have Form 1065, and you have individual income tax return. For LLC, you have a clearly separated business entity from the owners. Income loss is reported by owners, and you still have the Form 1065 and individual income tax return. For C Corp and S Corp, we have the same separation of a personal asset versus business asset. And at the C corporation level, you have corporate taxes paid and a second tax paid by owners. We have the double taxation. And the forms, the tax form that are filed, you have Form 1120 and Form 1040, right? And for the S Corporation, you have 1110S. And you have also Form 1040. And the income loss, of course, is reported by the owners. All right, folks, this is it for today's conversation. I was talking to you, just kind of want to do a quick recap here. I was talking to you about the tax benefits of a different, I would say, business structures. So I spoke to you about the sole proprietorship, the LLC, the also proprietorship versus LLC from a tax perspective, S corporation versus C corporation from a tax perspective, single member and multi-member LLC taxes, and how to start an S Corp and how to choose, very important, the smart incorporation type. I will see you next time. Thank you so much for your attention. Happy filing, and until next time, remember, stay marvelous.